Hello, it's Shoe Dog Charts. Now, investing in dividend stocks is a great way to build your long-term wealth. Studies have shown that dividend-paying stocks outperform non-dividend paying stocks, and a dividend reinvestment plan, or a DRIP, which allows you to use dividends to buy more stock, is an excellent way to grow your portfolio without putting in any more of your hard-earned cash. Of course, it's even better if you can count on those stocks to keep paying you dividends for life. So let's take a look. The first stock we're going to look at today is International Paper. And if you're looking for a dividend stock that will keep paying you indefinitely, then you should find a company that is large, mature, has plenty of cash flow, sells products that its customers couldn't replace very easily, and is so boring you would overlook it otherwise. Well, that's IP. International Paper is the lowest cost manufacturer of corrugated products. It's also one of the largest. The company can produce 13 million metric tons per year from 166 plants in the United States. This manufacturing capacity has allowed its industrial packaging division to turn in $14.2 billion in sales and $1.65 billion in operating profits in 2016. The segment has also been a free cash flow machine. The pulp and paper leader averaged $1.8 billion in free cash flow from 2012 to 2016. That's all great news for dividend investors, especially considering management has pledged to return 40% to 50% of free cash flow to shareholders every year through dividends and/or share repurchases. The annual dividend has increased from $1.05 per share at the end of 2011 to $1.90 per share this year. So let's take a look at the charts. What we're looking at here is the 20-year monthly chart on International Paper, and the symbol is IP. And as the price chart shows, we had a bottom here in early 2016 with a V-shaped recovery moving up to the current price of $62.26, not quite a double from the bottom in 2016. Moving here into the MACD, we also show the bottom here with the fast line moving through the trigger line and above the zero line, but some hesitation here in 2017. We'll see that when we come to the histogram, and as you can see here, the histogram has been moving negative since early 2017, with maybe a slight positive pop in early 2018, but the overall trend is downward. Moving into the momentum, that confirms the histogram with the downward move here. Into the price rate of change, we have a bounce back here in late 2017 from under the slow line, but that to me indicates we have a weakening stock. Moving down into the relative strength shows that we're at a fairly healthy rate of 73.53, moving up not quite into oversold territory, but on its way up. But this looks pretty strong. Moving down into the stochastic also look relatively strong, so we have a contradiction between some of the oscillators. The volume has been tapering off since about early 2016, so it's not too significant, so I would say that's moderately negative. And then the Williams, we show a relatively decent amount of strength here into early 2018. But let's go back up here to the price chart. And we see here that we're elevated above all of the EMAs, the 200, the 50, and the 20 EMA. But as you can see here in the histogram, it has a history of going positive and going negative at certain periods of times. And it looks like, again, we're heading here negative. So back up to the price chart, my recommendation would be first do some more fundamental analysis, but given that this does have a history of up and downward moves, And given the elevation above the 20 EMA, I would wait for a pullback before I would consider buying international paper. So let's go to the next stock. And our next stock is Walmart. With $486 billion in revenue last year, Walmart is the biggest company in the world by sales. The retailer has used its economies of scale, supply chain expertise, and reputation for low prices to carve out leading positions in the retail industry, not just at home, but internationally as well. Not surprisingly, Walmart is also a reliable dividend payer. The retailer has increased its dividend payout every year for 43 years in a row. As the stock has soared this year, the dividend yield has slipped to about 2.1%, and recent annual dividend hikes have been modest at just a penny or 2%. However, dividend growth could accelerate in 2018 as profits are expected to increase again after years of investment in higher wages and e-commerce. Walmart's payout ratio is below 50%, meaning it has plenty of room to raise its dividend payouts even if profit growth lags. So let's take a look. And the chart we're looking at here is the 20-year monthly chart on Walmart stores, and the symbol is WMT. And we can see that we had a bottom in the price here in late 2015, with the price bouncing off of the 200 EMA, moving through both the 50 and the 20 EMA on up, and then a recent surge in the last few months of 2017 into 2018. And we see that surge here as well as in the MACD, with both the fast line and the slow line accelerating well above the zero line. And that is also reflected here in the histogram, as well as the momentum and the price rate of change. Through here to the relative strength index, the RSI is showing an 85.68, so that's a very strong move from back here in late 2015. And in here to the stochastics, we are into the oversold territory above 80 at this point in time. And moving on here into volume, volume is fine. Looks like it's relatively steady. No concerns for me at this point. And then the Williams also showing a very strong move from, say, mid-late 2015 on up. Moving back up here into the price chart. Once again, we can notice that the current price is elevated well above all of the EMAs, particularly the 20 EMA, and if you take a look at its history, it does not elevate above the 20 EMA very often, and when it does, such as back here in late 1999, early 2000, the price seems to come back to that moving average. And we can see that here again in the 2008 timeframe, as well as a few times here in 2012, and then again here in late 2014, 2015 with that ultimate sell-off. So my current recommendation is conduct some further fundamental analysis, but let's just wait to see the price and see if it stock market gravity takes hold and brings the price back to that 20 EMA. So now let's move to our last stock. And our last company is WP Carey, which is a real estate investment trust, or a REIT. And WP Carey has been investing in commercial real estate for more than 40 years. While the company has only been public since 1998 and didn't become a REIT until 2012, it has consistently paid dividends to investors each year. In fact, it has increased its payout every single year since going public. That steady stream of income should continue to flow to investors in the years ahead, as WP Carey primarily owns net lease properties, which generate consistent cash flow because the tenants generally pay most of the operating expenses. Currently, the company owns 890 properties around the world, which have a weighted average remaining lease term of 9.5 years and a current occupancy rate of 99.8%. These factors provide the company with a good foundation for paying dividends. So let's take a look at the charts. And this is the 20-year monthly chart on WPC Carey. The symbol is WPC. And as we can see here, WPC has been moving sideways within this trading range, up and down, more or less around the 20 and the 50 EMA, but well above the 200 EMA. Moving down here into the MACD, I see a little bit of a different story with the top here in the MACD, but a bottom here in early 2016 and perhaps a confirmation bottom here in early 2017 with a move up, but perhaps a downward move here in the last few months of 2017 into 2018. Shows us much the same here in the histogram. And then the momentum indicator as well, moving down. However, we're above and below the zero line here, and that is reflected as well as in the price rate of change. And in here to the relative strength, we're at a moderately low level of 45.18, but still above and below the midline there. Into the stochastics, the recent signal here is that the fast line is going to move through the slow line, perhaps head down toward that midline or 50. The volume is, say, moderate negative, not significant, so not a real concern at this point in time. And then into the Williams, and although we had a fairly strong couple of years here, the recent move in the Williams down below the midline or 50, perhaps continuing on down, is a caution sign for us. But moving back up here into the price chart, we're at a level here of bouncing off at just above 70, moving on down here. And given the pattern that it's shown here in the last few years, I would imagine that the price is going to continue on down, perhaps through the 20 and the 50 EMA, and perhaps even under $60 a share. So my recommendation, as always, is to continue your fundamental analysis, but wait for a pullback in this stock, say in the $60 per share area, and at that point you may perhaps add it to your portfolio. But for now, I'd say let's just wait and see what happens here in the future. So for today, that's Chew Dog Charts, and we'll see you next time. Thank you.